There are three main chart types that traders use to read the markets, specifically to determine price movement and identify trends.
The first chart we are covering in the Britt Technical Analysis Basics video series is the bar chart.
This is a Western technique for price charting, comprised of a vertical line that represents the price range of a specific time period. The time period depends on your chart. The most popular periods are hourly, daily, weekly, and monthly. The highest point on the bar represents the high price of the financial asset, and the lowest point represents the low price. The distance between these 2 points is the price range.
A tick to the left represents the opening price, and a tick to the right represents the closing price.
The vertical line, together with the left and right ticks, is referred to as the bar. 2 consecutive bars represent specific relationships that technical traders recognize. A down day implies more sellers than buyers. An inside day implies a pause in market action. An outside day implies a lot of activity and volatility in the market.
These 4 relationships help technical traders understand changes in buying, selling, market pauses, and volatility.
Next up is one of the most important and popular price charts, the Japanese candlestick. Learn to trade consistently. Master the financial markets with Britt Online Trading Academy. Subscribe for more.
Forex and CFD trading involves substantial risk. It may not be suitable for every investor. Never trade with money you cannot afford to lose.
Please like and subscribe.